If you bought gold this year, what I'm about to share could be the difference between protecting your wealth and watching it evaporate. Because right now, something is happening in the gold market that most investors have completely missed. And if you don't understand what's unfolding, you could be making a critical mistake with your hard-earned money. Let me start with a question that should keep you up at night. Why is gold behaving so differently than it did during every other major rally in history? Think about it. We've seen gold surge before. We watched it climb in the 70s. We saw it spike in 2008. We witnessed the run-up in 2011. But this time, something fundamental has changed. And that change is creating both enormous opportunity and hidden danger for anyone holding gold right now. Here's what's actually happening. Gold has been on an absolute tear. We're talking about a move that has shocked even the most seasoned precious metals analysts. The metal has climbed from lows that seemed unthinkable just a few years ago to levels that are testing all-time highs. But here's where it gets interesting. This isn't your grandfather's gold rally. This isn't driven by the same forces that pushed gold higher in the past. And that's exactly why so many investors are getting this completely wrong. Let me paint you a picture of what's really going on behind the scenes. Central banks around the world are buying gold at a pace we haven't seen in decades. I'm not talking about small purchases here and there. I'm talking about systematic, aggressive accumulation that tells you everything you need to know about where this is headed. The People's Bank of China has been adding to their reserves month after month. The Reserve Bank of India is stockpiling. Poland, Hungary, Singapore, they're all loading up. These aren't emotional retail investors chasing a trend. These are the most sophisticated financial institutions on the planet, and they're voting with billions of dollars. But here's what nobody's telling you. It's not just about how much gold they're buying. It's about why they're buying it and what they're preparing for. Because when you dig into the data, when you look at the actual mechanics of what's happening in the global monetary system, you start to see a pattern that should terrify anyone holding significant wealth in traditional assets. Before we go any further, I want to make sure you have access to something that could be incredibly valuable for your financial future. I've put together a comprehensive guide that breaks down the saving secrets thousands of American retirees are using right now to protect their hard-earned wealth. It's completely free, and you'll find the link in the description below. This guide covers strategies that most financial advisors won't tell you about, and it could make a massive difference in how you navigate what's coming. Grab it now while it's still available. Now, let's talk about what's really driving this gold market. Because if you think this is just about inflation or interest rates or some temporary economic uncertainty, you're missing the bigger picture. What we're witnessing right now is nothing less than a fundamental restructuring of the global financial system, and gold is sitting right at the center of it. Think about what's happened over the past few years. We've seen the weaponization of the dollar in ways that were unthinkable just a decade ago. Countries are being cut off from the SWIFT system. Assets are being frozen. Sanctions are being deployed as economic weapons. And every single time that happens, every single time a nation sees the dollar used as a tool of coercion, they ask themselves one critical question. How do we protect ourselves from this? The answer they're arriving at is gold. Physical gold. Not paper promises. Not ETFs. Not futures contracts. Actual metal sitting in vaults under their control. Because gold can't be sanctioned. It can't be frozen. It can't be devalued by a central bank printing money. It's the ultimate form of monetary sovereignty, and right now, nations around the world are racing to secure as much of it as they possibly can. But here's where this gets really interesting for you as an individual investor. Because what works for central banks works for individuals too. The same forces that are driving sovereign nations to accumulate gold are the exact same forces that should be driving your investment decisions. The difference is, most people don't see it yet. They're still operating under the old paradigm. They still think gold is just a hedge against inflation or a safe haven during market crashes. They don't understand that we're in the middle of a complete monetary regime change. Let me give you a specific example of what I'm talking about. Look at what happened with Russia after the sanctions were imposed. Overnight, hundreds of billions of dollars in foreign reserves were essentially frozen. Assets that Russia thought were safe, that they thought were liquid, became completely inaccessible. Now, Whether you agree with the sanctions or not is irrelevant. What matters is what every other country learned from watching that happen. They learned that holding your reserves in dollars, in euros, in any fiat currency controlled by someone else is a massive risk. So, what did they do? They started converting those reserves into gold. And not just a little bit. We're talking about a wholesale shift in how central banks think about reserve management. The World Gold Council data shows us that central bank gold purchases have been running at levels we haven't seen since the 1960s. Think about that. We're talking about a 6-decade high in institutional gold buying, and it's not slowing down. If anything, it's accelerating. Now here's what this means for the gold you bought this year. You're not just holding a commodity. You're not just holding an inflation hedge. You're holding the asset that is being chosen by the world's most powerful financial institutions as the foundation of the next monetary system. That's the update you need to understand. That's the context that changes everything. But let's dig deeper into the mechanics of what's actually happening in the market right now. Because there's a technical side to this story that's just as important as the fundamental narrative. And if you don't understand the technical picture, you could make some serious mistakes with your positioning. Gold has been consolidating near all-time highs. We've seen it test resistance levels multiple times. We've seen it pull back, retest support, and then push higher again. This is classic accumulation behavior. This is what happens when smart money is building positions. They're not chasing. They're not panicking. They're methodically accumulating on dips and holding through the volatility. But here's what's fascinating. The usual correlation between gold and real interest rates has completely broken down. Traditionally, when real yields rise, gold falls. When real yields fall, gold rises. It's been one of the most reliable relationships in financial markets for decades, but right now, that relationship has decoupled. Gold is holding strong even as real yields have moved in ways that should have crushed the price. What does that tell you? It tells you that something bigger is at play. It tells you that the traditional models don't work anymore because the underlying dynamics have fundamentally changed. Let me walk you through what's happening in the physical market, because this is where things get really interesting. The premium for physical gold over paper gold has been widening. In some markets, you're paying significantly more to get actual metal in your hands than you would pay for a futures contract or an ETF share. Why? Because people are waking up to the difference between owning gold and owning a claim on gold. They're realizing that when things get really bad, when the system is under real stress, paper promises might not be worth very much. Look at what happened during the banking crisis last year. When regional banks started failing, when depositors started panicking, what did people rush to buy? Physical gold. Not gold stocks, not gold ETFs, physical metal. And the premiums spiked. Dealers were running out of inventory. Wait times for delivery stretched from days to weeks. That's a preview of what's coming on a much larger scale. Now, I want to address something that's probably on your mind. You're probably wondering, is it too late? Did I miss the move? Should I be taking profits? Should I be buying more? These are the questions I hear all the time. And the answer is more nuanced than most people want to hear. Here's the reality. If you bought gold this year, you're positioned in the right asset class. But whether you're positioned correctly within that asset class is a different question, because not all gold exposure is created equal. Owning shares in a gold mining company is very different from owning physical gold. Owning a gold ETF is very different from owning coins in a safe. And understanding these differences is absolutely critical to protecting your wealth. Let me tell you about something that could be a game changer for your retirement security. If you're sitting on $100,000 or more in retirement accounts, there's a strategy that thousands of Americans are using right now to protect their nest egg from what's coming. It's called a gold IRA, and it allows you to hold physical gold inside your retirement account without triggering any tax penalties. I've put together a detailed guide that walks you through exactly how this works, the pros and cons, and whether it makes sense for your situation. You'll find it in the description below. This isn't about making a quick buck. This is about protecting decades of hard work from the kind of monetary chaos that could wipe out traditional retirement accounts. Check it out if you want to understand how to truly hedge your wealth against market collapse, geopolitical instability, and the currency debasement that's accelerating right now. Now let's talk about where gold is headed from here, because understanding the destination is just as important as understanding how we got here. And when you look at the forces in play, when you look at the structural drivers that are pushing this market, the picture becomes pretty clear. First, let's talk about supply. Gold production has been essentially flat for years. We're not discovering major new deposits. The easy gold has already been mined. What's left is deeper, harder to extract, and more expensive to produce. Meanwhile, demand is exploding. You've got central banks buying, you've got Asian consumers buying, you've got investors buying, and you've got industrial users buying, because gold is critical for electronics, for medical devices, for all kinds of technology applications. This is basic economics. When supply is constrained and demand is rising, price has to go higher. But here's what makes this different from a normal supply-demand imbalance. The demand we're seeing isn't cyclical. It's not going to reverse when the economy improves or when interest rates change. This is structural demand driven by a fundamental loss of confidence in the existing monetary system. Think about what that means. Think about what happens when the world's reserve currency is no longer trusted. Think about what happens when countries that have been accumulating dollars for decades decide they don't want to hold them anymore. Where does that money go? It goes into hard assets. It goes into gold. And we're just at the beginning of that transition. Let me give you some historical context that will help you understand the magnitude of what's possible here. In 1971, when Nixon closed the gold window and ended the dollar's convertibility to gold, the metal was trading at $35 an ounce. By 1980, it had surged to over $800. That's more than a 20-fold increase in less than a decade. Now, I'm not saying we're going to see that kind of move again, but I am saying that when monetary regimes change, when the fundamental structure of the financial system shifts, gold doesn't just go up a little bit, it goes up a lot. And here's what most people don't realize. That 1970s gold bull market wasn't driven by inflation alone. It was driven by a loss of confidence in the dollar. It was driven by the realization that the post-World War II monetary system was breaking down. Sound familiar? Because that's exactly what's happening right now. We're watching the post-Bretton Woods system, the system that's been in place for over 50 years, start to crack at the seams. The difference is this time the stakes are even higher. In the 70s, the dollar was still the dominant reserve currency. There was no real alternative. Today, we're seeing the emergence of alternative payment systems. We're seeing bilateral trade agreements that bypass the dollar entirely. We're seeing the BRICS nations working on their own currency arrangements. The world is actively trying to reduce its dependence on the dollar, and every step in that direction is bullish for gold. Now, let's talk about the elephant in the room. Debt. The United States is carrying debt levels that would have been considered impossible just a generation ago. We're talking about trillions upon trillions of dollars in obligations. And here's the thing about debt at this scale. There are only 3 ways to deal with it. You can pay it back through economic growth, you can default on it, or you can inflate it away. Economic growth at the pace needed to outgrow this debt? Not happening. Default? Political suicide. That leaves inflation, and that's exactly what we're getting. The Federal Reserve can talk all they want about fighting inflation, about getting it back to 2%, about maintaining price stability. But the math doesn't work. The debt burden is too large. The only way out is to devalue the currency. And when the currency is being devalued, gold goes up. It's not complicated. But here's what makes this moment unique. It's not just the United States dealing with unsustainable debt. It's Europe. It's Japan. It's China. It's the entire developed world. We're in a global debt trap, and the only way out is coordinated currency debasement. That's why central banks are buying gold. They know what's coming. They're preparing for it. And if you're not preparing for it too, you're going to get caught on the wrong side of the biggest wealth transfer in history. Let me tell you about something I've been watching very closely. The ratio between gold and other assets. Gold versus stocks. Gold versus bonds. Gold versus real estate. These ratios tell you a lot about where we are in the cycle. And right now, gold is still relatively cheap compared to financial assets. The stock market is trading at valuations that are historically elevated. Bonds are offering negative real yields in many cases. Real estate is priced for perfection. But gold? Gold is just starting to reflect the reality of what's happening in the monetary system. What does that mean for you? It means there's still time. It means that if you bought gold this year, you're early, not late. It means that the real move, the move that's going to shock people, probably hasn't even started yet. Because when the mainstream finally wakes up to what's happening, when pension funds and insurance companies and sovereign wealth funds all try to increase their gold allocations at the same time, that's when you're going to see price action that makes everything we've seen so far look tame. But here's the critical part. Here's the update you really need to understand. It's not enough to just own gold. You need to own the right kind of gold. You need to own it in the right way. And you need to have a plan for what you're going to do as this situation unfolds. Physical gold is the foundation. Coins, bars, metal you can hold in your hand. That's your insurance policy. That's your protection against the worst-case scenarios. But you also need to think about liquidity. You need to think about how you're going to access that wealth when you need it. You need to think about storage, about security, about all the practical considerations that come with owning physical metal. And then there's the question of allocation. How much of your portfolio should be in gold? That depends on your situation, your risk tolerance, your time horizon. But here's what I can tell you. If you have zero exposure to gold right now, you're taking a massive risk. You're betting that the current monetary system is going to hold together. You're betting that central banks are going to figure out how to manage this debt without destroying the currency. You're betting that geopolitical tensions are going to ease rather than escalate. Those are bets I wouldn't want to make. On the other hand, if you're 100% in gold, you're probably overexposed. Because as bullish as I am on gold, as much as I believe it's going to be one of the best performing assets over the next decade, you still need diversification. You still need to be able to function in the existing system while it's still functioning. You need balance. Let me share something with you that I think is really important. I've been studying gold markets for a long time. I've watched multiple bull markets and bear markets. I've seen gold go from a few $100s to over 2,000 and back down and back up again. And one thing I've learned is that the biggest mistakes investors make aren't about timing. They're about conviction. People buy gold when it's going up. They feel smart. They feel like they're protecting themselves. But then it pulls back. It consolidates. It goes through a period where nothing seems to be happening. And they get bored. They get nervous. They start questioning whether they made the right decision. And they sell. They sell right before the next leg up. They sell right before the move that would have made all the difference. Don't be that person. If you bought gold this year, you bought it for a reason. That reason is still valid. In fact, it's more valid now than it was when you made the purchase. The forces driving this market are accelerating, not decelerating. The risks to the financial system are growing, not shrinking. The case for gold is stronger today than it was 6 months ago, a year ago, 5 years ago. But you need to understand what you own and why you own it. You need to be able to look at a 10 or 20% pullback and see it as an opportunity, not a reason to panic. You need to have the conviction to hold through the volatility, because there will be volatility. There always is. But the long-term trend is clear. And if you can stay focused on that trend, if you can tune out the noise and stick to your strategy, you're going to be in a much better position than 99% of investors out there. Now, let's talk about what could go wrong, because it's important to understand the risks, not just the opportunities. What could derail this gold bull market? What could make your investment lose value? The biggest risk is a genuine solution to the debt problem. If somehow, some way, governments figure out how to grow their way out of this debt without inflating the currency, that would be bearish for gold. But I'm going to be honest with you. I don't see how that happens. The math doesn't work. The political will doesn't exist. The structural problems are too deep. Another risk is a major deflationary event. If we see a collapse in credit, a massive deleveraging, a true deflationary spiral, gold could struggle in the short term. But even then, I would argue that gold would outperform most other assets. And more importantly, any deflationary event would be met with such aggressive monetary and fiscal stimulus that we'd end up right back in an inflationary environment. So even that risk is probably temporary. The third risk is confiscation. Governments have seized gold before. It happened in the United States in 1933. It could happen again. But here's the thing. If we get to the point where governments are confiscating gold, we're in a scenario where you're going to be really glad you had gold to confiscate, because that means everything else has already fallen apart. That means the system is in full crisis mode. And in that environment, having held gold, even if some of it gets taken, is still going to leave you better off than if you had held nothing but paper assets. So yes, there are risks. But when you weigh those risks against the risks of not owning gold, against the risks of being fully exposed to a monetary system that's clearly breaking down, the choice becomes pretty clear. Let me bring this back to where we started. If you bought gold this year, you need this update. You need to understand that you're not just holding a commodity. You're holding a monetary asset that's being remonetized in real time. You're holding the asset that central banks are choosing as the foundation of the next financial system. You're holding the one form of money that has survived every currency collapse, every empire's fall, every monetary experiment in human history. That's not hyperbole. That's not sales talk. That's historical fact. Gold has been money for 5,000 years. Every fiat currency that's ever existed has eventually failed. Every single one. The dollar, the euro, the yen, they're all fiat currencies. They're all backed by nothing but confidence. And that confidence is eroding. So what should you do now? First, if you haven't already, make sure you understand exactly what you own. If you own gold ETFs, understand the counterparty risk. Understand that you don't actually own the metal. Understand that in a real crisis, you might not be able to get your hands on physical gold. If you own mining stocks, understand that you're taking on company-specific risk, operational risk, political risk, in whatever jurisdiction those mines operate in. Second, consider increasing your allocation if you're underweight. I'm not saying go all in. I'm not saying bet the farm. But if gold represents less than 5 or 10% of your portfolio, you might want to think about adding to that position, because the risk-reward at these levels still favors the upside. Third, think about how you're storing your gold. If it's all in one place, that's a concentration risk. If it's all in a bank safe deposit box, think about what happens if banks close or if there are capital controls. Diversify your storage. Keep some at home in a good safe. Keep some in a private vault. Keep some in a different jurisdiction if you have significant holdings. Fourth, have a plan. Know what you're going to do if gold goes up another 50%. Know what you're going to do if it pulls back 20%. Know what your exit strategy is if you even have one. Because for many people, gold isn't something you sell. It's something you hold as permanent insurance against monetary chaos. And finally, stay informed. The gold market is complex. It's influenced by dozens of different factors: interest rates, currency movements, geopolitical events, central bank policy, mine production, jewelry demand, industrial demand, investment demand. You need to understand these dynamics. You need to be able to separate signal from noise. You need to be able to think independently and not just follow the crowd. Here's what I want you to take away from this. The gold market is at a critical juncture. We're in the early stages of what could be one of the most significant bull markets in history, but it's not going to be a straight line up. There will be pullbacks. There will be periods of consolidation. There will be times when it feels like nothing is happening. And those are the times when weak hands sell and strong hands accumulate. If you bought gold this year, you made a smart decision, but now you need to follow through. You need to have the conviction to hold. You need to understand the bigger picture. You need to see beyond the day-to-day price movements and focus on the long-term trend. Because here's the truth. We're living through a monetary revolution. The system that's been in place for decades is breaking down. A new system is being born. And gold is going to play a central role in that new system. The central banks know it. The smart money knows it. And now you know it too. Before we wrap up, I want to make sure you take advantage of the resources I've made available for you. That free guide I mentioned earlier, the one that covers the saving secrets thousands of American retirees are using to protect their wealth, it's waiting for you in the description. And here's something special for those of you who've watched all the way to the end. If you're an American retiree with at least $100,000 in any retirement account, and you mention that you watch this video, you'll get access to an exclusive one-on-one educational web conference. No obligation, no pressure. Just valuable information that could make a massive difference in your financial future. This is only available to people who take action, so don't wait. The bottom line is this: gold isn't just going up because of inflation. It's not just going up because of uncertainty. It's going up because the world is fundamentally changing how it thinks about money. And if you understand that, if you position yourself accordingly, you're going to be on the right side of one of the biggest wealth transfers in history. The update you needed is simple. Hold your gold. Understand why you own it. And prepare for what's coming. Because what's coming is going to reshape the financial landscape in ways most people can't even imagine. And those who are prepared, those who saw it coming and positioned themselves accordingly, they're going to be the ones who not only survive but thrive in the new monetary order that's being built right now.